You may have heard of the villain known as the tax man, but there's a lot that you can do about tax. The problem is you could write a book about tax. There are books about tax, but I'll try and summarise some of the key points. Pensions. So there's been a lot about pensions recently in the press. Ignore all of that. Pensions are still hugely efficient, so long as you invest in them within the allowances. As an example, for every £8,000 you put into a pension, the government will add 2,000, so you get 10,000. And if you're a high rate taxpayer, you can reclaim through self-assessment an additional £2,000, which you get back as cash, and you can do whatever you like with it. So for your £8,000, you've got £4,000. You've got a 50% uplift on your investment. And even when you come to take the money out at the end, 25% is tax-free, and the balance is taxed as income. So let's say you've stopped working and you've got your personal allowance back. If you draw that balance within the personal allowance, it's still tax-free, and then it goes through the bands. After that, you've got the individual savings account, the ISA, £20,000 a year, and can be invested into an ISA, either cash or stocks and shares, and that will protect it from all tax, with the exception of inheritance tax. After that, you've either got the general investment account, which is a sort of naked investment subject to all the normal taxes, capital gains tax, dividend tax, interest tax, but you've got your £3,000 capital gains exemption to use against it. And then you've got investment bonds, which is a different tax regime, but they can come into play sometimes. That's going to require a completely separate video. After that, you've got the likes of the Venture Capital Trust, which is essentially an ISA, but you get 30% back on your invested capital against your income tax bill. So if you put £100,000 into one and you've got an income tax bill of more than £30,000, you can get £30,000 back. And then you've got an enterprise investment scheme. It doesn't function like an ISA, like a VCT, but it does become inheritance tax free, and you also get your 30% capital back. So the problem with them is that they are risky. You're invested in small companies. You get a tax break for a reason. But the point is to say that there's lots of things you can do about tax. Tax, again, can mitigate against the growth of your wealth over